All right, welcome back to another exciting episode of the Deduction Desk, where we talk about taxes and stuff that you only care about when you owe more money to the IRS. Today, we're going to be focusing on a big word that is very misunderstood from a tax planning perspective, and that word is trust.
Yeah.
And not the trust of your accountant or the trust of your advisor, but the word trust, meaning what trust can I use?
Yeah, well, I think trust is like misunderstood all the time in every context.
Well, and I think we get it often, right?
Yeah.
The question becomes, okay, well, I've heard of these trusts that I can set up that put us in a position to save in taxes or put us in a position to pay the government less. And we're here to make sure that we debunk as much of those conversations as possible, because quite frankly, it's getting pretty overwhelming, the amount of people that think they can save money by setting up a trust, when the reality is you can't, unless you want to give up full control and full management of those assets. And that's some of the stuff that we're going to go into on this episode.
Yeah, you have some of these influencers that'll convince you that set up a living trust with them for the low price of $20,000,
right,
and you'll avoid all your taxes moving forward. And it's just not true.
Well, and I think influencers and people that are online, are doing that bait and switch type of category, right? Put out something that's exciting for people to dive into, to hear about, and then you actually get into the meeting and 90% of what you're talking about doesn't save you in taxes.
Yeah.
And the percentage that does save you in taxes, you wouldn't do anyway, right? So,
or you don't qualify, or it's not a tax
or it doesn't
you would
make
ever pay
sense
in
for
your
you
life.
to do it, right?
Yeah.
Your estate, isn't big enough in order for you to accomplish those things or want to accomplish those things. So let's start off with the two biggest categories of a trust, right? Number one is a revocable living trust, and then number two is an irrevocable trust. And those are the only two that you need to be privy of. Revocable, meaning you have the ability to revoke any of the changes that you made, which means that you also have management and some level of control of the trust itself. An irrevocable trust, which means you're making a decision to no longer be involved in those assets anymore. And where those assets go and how those tax consequences are set are based on what type of those irrevocable trusts are set up. So we'll dive briefly into some of those, but I think it's important to really think to yourself, am I using a revocable trust or am I using an irrevocable trust? And the most important part of this entire video, I think from a tax saving standpoint, if you're watching this video and saying, okay, I want to watch this video because I want to learn how to set up a trust and save in taxes, the only way that you save money from setting up a trust is if you relinquish all management, all access, and all rights to the asset that you're going to put in the trust.
Yes.
So if you want to move a property out of your estate, you want to move cash out of your estate, you want to move an investment out of your estate, you want to move vehicles out of your estate, anything that has to do with that vehicle can no longer be in your control to any extent in order for it to be some benefit from a tax perspective. And most of the time, it's only on the growth of that asset moving forward. So where I think probably is the best place to start, right, is who does not need a trust for tax saving?
Right, for tax saving.
Yes.
Because...
And I think that's what we're talking about, right?
Yeah, we're not here to talk about, hey, you want to simplify your will or your end-of-life planning where, the right people are going to get the right amount of things and you're putting stuff away for your future grandchildren, or you're setting up a charitable trust because you really want to give away a large portion of your income to charities. These are not the things that we're really getting into, and there's benefits with it. In fact, one of the biggest ones where I've seen people benefiting from these trusts is, you get sick and you have to be in long-term care and you don't have all of your stuff in a medical trust or a living trust, and now all of a sudden you're going $10,000, $12,000, $20,000 a month in these assisted living facilities. Yeah. So I think there's value to these things, but just not from a tax perspective like people claim there is, right? So who doesn't need I'd say 99% of the people watching do not need a trust, okay?
Yeah, if you're watching this, there's a 99% chance that for tax purposes, you're not going to get any benefit.
And I use that number for a reason. It's not just me pulling it out of my ass. It's 99% because 1% of the people are above $30 million in net worth, right? So if you're an individual single person and you're thinking about the future, that number is 10 to 12 million. And the way that these trusts really work is you're putting in the assets before you hit that $10 to $12 million mark, so that the growth that occurs from there till hopefully billions of dollars for you, viewer, who is going to be the billionaire in our group that's watching. All of that avoids estate taxes. You personally are still probably not going to get much tax savings from having this trust. There's other things you can do to avoid some of the taxes you may have, but this particular, that growth from 10 to 100 million, assuming it's from income and distributions and dividends, is probably going to be taxed anyway. If there's unrealized, if it's stock appreciation, if it's something you're not going to sell and you want to pass on all this wealth to your children, this is a good way to do that tax-free. That $100 million of wealth from based on your $10 million exemption limit is going to basically save you about $40 million in estate taxes. So if you're ultra rich or if you're on your way to becoming ultra wealthy, then certainly the irrevocable stuff, the tax saving stuff is relevant and pertinent to you. If you're somebody who is just like everybody else and you're working, you're plugging away, you're trying to make ends meet, and maybe you'll end up with $1 million in your retirement by the time you're done, maybe you end up with $5 million in your retirement by the time you're done, you're still not somebody who needs a trust for tax savings purposes.
Yeah, I mean, and if you look at the tax code and there are specific rules around all this, because I'm assuming as we've gone on as a society, especially in America, we've tried to find every loophole you could possibly find.
Yeah.
But there are specific taxes for trust and the growth of trust that you're going to pay the taxes on, or the trust will pay the taxes on. And those are the highest brackets you can get.
Yeah.
So even if you said, hey, look, I want to transfer money into this trust because I want to use this trust for X, Y, and Z, and I want the trust to pay the taxes, you might have been actually paying less taxes as an individual before you move the money to the trust and put yourself in the highest bracket.
Case in point, putting your home in a trust.
Yeah, 100%.
Using the $500,000 exemption on your sale of your primary residence. If you sell your primary residence, you lived in there 2 out of 5 years and you're married, the first $500,000 of capital gain you don't have to pay tax on.
Right.
Whereas if you're putting it in the trust, you may lose that. There's other scenarios where maybe the majority of your wealth, maybe you're close to this $10 to $12 million number and you're like, hey, I really want to put it away. If the majority of your income is in a 401k or an IRA, that trust isn't going to help you. When it's distributed out, there's going to be tax consequences either at the estate level, or there's going to be minimum required distributions that your beneficiaries will have to take from those retirement accounts.
And most of those accounts have a direct beneficiary, right? Your IRA, an annuity, your 401k, you have a designated beneficiary for those assets, right? When you purchase a home, when you purchase a car, when you own a business, there's no beneficiary line. Who are you leaving this car to when you pass away? It goes to your estate, right? So those revocable trusts are really help to organize some of those things, right? And avoid probate, meaning getting it through your estate planning faster. The irrevocable trusts are meant to say, I don't want this to be part of the total estate that I'm actually worth. But to Sagar's point, you're putting 401k and IRA money into a trust. It really doesn't make sense because the beneficiary designation is meant to supersede your probate. It goes straight to your beneficiary and it makes things easier. We've had clients who've had majority of their assets are in retirement.
Yeah.
And they're talking about trust, right? And there's no real need for a trust because the beneficiary already is designated. So you're going directly to the person through probate. You don't have to wait for that stuff to settle. It's already designated, gets sent out. We actually had a client that the money had passed away and they named their estate the beneficiary on their IRA, right? So the question was, does this trust have to take the distributions over a 10-year period of time? Is there a way to get the beneficiary changed to the actual person so it can go direct? The answer is a very complicated situation for something that didn't need to be complicated.
True.
Right? You could have named who the beneficiary was. You could name 7 different beneficiaries and change it to whatever direction you want. And it doesn't necessarily mean that you can't set up the beneficiary to go to your will or to go to a trust that then tells where the money goes. But for IRA accounts, annuity accounts, 401k accounts, those are going direct, right? So that's important to keep in mind.
Yeah, and like with all professionals, there's sometimes, you're either incompetent professionals that you run into, right, or you run into ones that are malicious and trying to overbill. And that happens in the trust planning world as well as the accounting world, the finance world, the medical world. It happens everywhere. It exists everywhere. So, there's a lot of great tools that you can use to check to see if what you're getting into is, overvalued for you. But generally, I think those things that we were saying before, who is not somebody who needs to get a trust? Not saying you don't have to do it, not saying you shouldn't think about it or see if there's another aspect to it outside of the tax savings that might help you. But from a tax savings perspective, you're worth less than $10 to $12 million. Most of your wealth is tied up in retirement, you don't have a big like a retirement plan that you need to put into place with a bunch of different exes or a bunch of different children, and you just want to simplify, it may not be worthwhile to go down this irrevocable trust route.
Yeah. And, I think what could be good, especially for maybe the potential 1%ers or the ones who are building up a business that we see exponential growth over your lifetime and you really do anticipate having a sizable estate, is who actually does need a trust. I think it's funny. I've had a meeting with a client and, their estate at this point was about 10 to 12 million.
Yeah.
And after I went through all the ramifications of what your Medicare IRMA payments could go into, what your Social Security could increase by, depending on the income that you're getting from some of those assets. The answer was, I didn't realize that having too much money was a problem too.
Yeah.
Right.
Yeah.
And again, like most people don't think about it. You think, all right, I have $12 million. I did great. And the answer is you did, but there's a lot of complications now that come into having too much money because there's so much income that's coming in. It's going to offset things like what your Medicare costs are. It's going to offset things like what your Social Security taxes are going to be. So the first thing really to look into is people with a state tax exposure of 10 to 20 million. And I think 10 million to start, because most of us don't realize that, yes, if you're watching this video and you're like, man, if I had friggin' $10 million, I don't know what I would do with it. I probably wouldn't be watching this video.
Yeah.
Right. But if you
and there are people who are like, if I ended up with 10 million, something must have gone terribly wrong.
Yeah, right. Yeah, there's people that are like 10 million is chump change, or there's people like, if I had 10 million, I'd probably be dead.
Yeah.
But when you're building up your financial profile and you're building up your estate, a lot of the times you get into a position where you're making that amount of money and you're not using all of it. So what happens? You put it into investment accounts, you put it into real estate property, you put it into, investment properties, whatever else it is, other businesses, right? You angel invest in businesses. And now your estate becomes very complicated. Who owns those businesses in the event that you pass away? How do you make sure that as they continue to grow, if you're getting dividends, you're getting real estate income, you're getting business income, that income doesn't end up hurting you more than that's benefiting you?
Or if you're changing your will, right?
Right.
Now you have to go and list out the 500 different things you're invested in.
Right.
Now versus just adjusting the trust.
And all of those things are things that, people with that level of tax exposure it's important to keep in mind. Like one thing that I think is important just for kind of like the everyday person to think about, and maybe some of you who are worth 20 plus million, if you have a real estate portfolio that is a $20 million real estate portfolio, and eventually we plan on it being 30 plus million or north of that, which is above the federal exemption rate if you're married, the one thing that you don't realize is that, okay, I have 3 children. If I'm 70 years old or I'm 75 years old, and more than likely there aren't 75-year-olds watching YouTube. It'd be impressive. I'd give you props if you're 75 and you're watching this video.
My uncle watches shorts on there all the
See,
time.
there you go. All right. So if your uncle's watching this, right, this is for you. In those situations, if you pass that benefit on and there is estate tax that's owed, the IRS isn't going to tell your kids, we'll wait for you to sell the properties, right? Take your time. They're going to say, here's how much over your estate was. Here's how much taxes you owe. Find the money and give it to us.
Yeah, go fire sale properties.
Right. So now all of a sudden I'm handed a property portfolio of 30 properties. I owe $2.5 million in estate tax and I got no cash from the property, right? I got no liquid cash that I can do. So what do I have to do? I have to sell the business. I have to sell the property so I can fund the IRS. The IRS doesn't say to you, take your time. We don't want you to, lose money on the sale of this property. They say April 15th, it better be in our hands or we're going to start garnishing your wages, right? And that stuff is stuff that's very important to think about. So I want to name a few trusts that are irrevocable that I think have some monicum of benefit. And again, it's not going to be for a majority of these people, but slats, ILETs, grats, all of those types of trusts are trusts that are meant to remove the money from your estate so that when you pass away, your estate calculation is below the federal tax number.
Yeah.
And if it's above the federal tax number, well, then any of the money above that, you're paying the maximum tax rate on all of that money above the federal exemption.
And to be honest, I don't even see it as much with real estate people. Even though
Right.
real estate people go over this limit. Yeah, there's so much time where you can get to that point.
Right.
One, with the use of mortgages, because it's net asset value, right? Obviously, there's growth in the market right now, like over the last 5 years. So you're seeing a lot of people who are planning to be beyond that $30 million number later in life, hitting it a lot earlier. But, there's a lot of ways around that. Where I see a lot of people that need this type of planning are when you have a company that you started.
Right.
And now all of a sudden the company has taken off. And usually with these founders, with companies that are taking off very quickly, there's not not a lot of time to think about other things beyond just their business. And that's where having a slat come into play becomes valuable. The ILETs are valuable for a lot of people because it's just a way to get your insurance.
And it's a good thing. I mean, I'm glad you brought that up because life insurance policies, it's very important to understand that the life insurance policy is not removed from your estate if you're the beneficiary of the policy or your spouse is the beneficiary of the policy. So if you own the policy and you pass the death benefit on to whoever your beneficiary is, that death benefit is counted towards your estate. So some of you may be saying, well, I have a $5 million policy or a $6 million policy because I want to make sure that if something happens to me, my family's taken care of. And then you're one of these individuals that owns a business that's taking off, or your real estate property gets larger than you expect, and now you pass away, and that $5 million is counted towards your estate. So an ILET, which is an irrevocable life insurance trust, actually allows you to put the death benefit into a trust that is not in your estate. So now in that scenario where someone has a large business or they have a real estate portfolio and they want to make sure that their kids can continue on with their legacy of the business or continue on with the legacy of the real estate properties, now that ILET pays out the cash that needed in order to pay the estate tax. And then that supersedes what the cost is because now I have a lump sum of cash, right? So ILETs are a very useful tool from an estate planning purpose because you can remove the death benefit from your estate and leave liquid cash for people to pay those estate taxes if estate taxes are actually needed.
So that's like two groups of people that we've talked about now, right? Like the super high net worth people who are trying to do it that haven't done it previously, or people with highly appreciating assets like these businesses. Talked about the ILETs as well, so that's three.
Yeah.
The fourth one, I think that sometimes could help you even if you're below that threshold, and that has to do with kiddie tax.
Yeah.
So if your children earn over a certain amount of passive income from interest or dividends or stock trading, usually it's not because the kid is trading and earning all this income. It's because maybe their grandparents passed away and gave them a Fidelity or Charles Schwab account, and there's a bunch of income being earned in there. Those children get taxed at your tax bracket if it's coming through just a pure 1099.
Right.
But setting up some of these shelters where their trust, setting up a trust now for the children, the income can run through there, and then either you can pick up the taxable income, which would be the same as the kiddie tax, or the kid can pick up the income, or you can have taxable trusts that pay the tax at a flat rate, which might be lower than your personal tax rate if you're in a higher bracket. So that's another one. If you're somebody who deals with kiddie tax on a yearly basis, this is a way to potentially work around that as well.
And then I think the last one that's worth mentioning is the charitable trust, right? There's different types of charitable trust that allow you to either A, donate or set money into an irrevocable trust that the beneficiary is going to be the trust of the assets, but then you can collect the income off of those assets for a period of time, or the reverse. You can leave the income or set a designated income to the charity so that that income is taxed at the charity's level, which is zero, and then the beneficiary is your beneficiary when you pass away, right? So if I have $2 or $3 million and I have dividends of $100,000 coming off of that, and I said, look, I don't really need this. I don't want to give all this money to the trust, but I do want to get rid of this for my income purposes. You can set up some of these trusts that allow the income to go to the charity. Now you're donating every year to the charity, you're relinquishing your tax requirements, and then when you pass away, that lump sum asset then goes to a beneficiary that you want other than the trust. So those things are important to keep in mind because we've run into plenty of clients that have sat down and said, look, I have so much income coming in from my brokerage accounts, not realizing that, to that point, I have too much money, and now I pay too much for my Medicare tax. I'm paying too much on my Social Security tax. I don't even need this income, but I have nowhere else to put it. Maybe your kids are very successful and they don't want to take it on either. I've had all types of conversations from that capacity. That's where those charitable trusts, potentially come into play as well.
Yeah. When I think about these trusts, it's like there's definitely a place for them.
Yeah.
Right? There's definitely, special needs trusts, right?
Yeah, 100%.
Those are super valuable. Those make a lot of sense, like logically and logistically, but it doesn't save you money on taxes. So, I think maybe sometimes people hear the word trust fund and they're like, oh, this is like a rich people loophole.
I don't know where the trust, but it is overwhelming, right? The amount of people that are like, oh, well, I just want to set up a trust. And I'm like, you're worth $400,000. What do you need a trust for, right? And it's all in retirement, right? So, this video is hopefully to help people get past that point.
Maybe people also get scared. They're like, oh, I don't want to give half of it away if I die, right?
Right.
Or I don't want to get stuck in probate. It's say, if you're over that number, you already have heard this probably a million times from your accountant that, hey, you're getting too close. You need to go set up a trust. And that's when you should be really looking at these
or
things.
sitting down with a professional and learning what your situation is. And if you're working with one that's good enough, the word trust will come up when it's beneficial.
And you don't know how many times I've had calls with clients and they're sitting with some random lawyer, and the lawyer's on a Zoom from their living room.
Right.
And they're just talking about, we're going to set up this slat and this crut, and we're going to set up this eyelet, and we're going to do all these things. And I'm just like, this guy's worth like
$3,000, $5,000, $7,000, $15,000 in costs.
Yeah, it's like this guy has, maybe $500,000 in a 401k and a paid off house of $350,000.
Right.
And he's gonna make.
You don't
zero
need
savings,
all this stuff.
and you're gonna charge him like $30,000 to set this thing up. So
I agree, and I've seen that multiple times.
Yeah.